Hi everybody. So today we're going to do the DCF analysis for Home Depot. I haven't done this yet, I haven't built it out, so I'll be building it from scratch, having only glanced at the financial statements. So yeah, let's crack on. As we can see on the chart here, Home Depot is at pretty much all-time highs now. Over the last 5 years, it's been hitting this 400, 430, but well, 425 mark, and then pulling back. And is it going to go up or is it going to go down from here? Let's see based on its ability to generate free cash flow. So without further ado, let's go straight to the financial statements. Again, we go to the SEC Edgar site and we type in Home Depot, and we need this, sorry, not that one. We need this 10Q report. That's the latest, most recent financial statement. And then we also need the 10K, which is quite far down, the most recent 10K, the most recent annual report. And that is, here it is. So I've got them open already. So yeah, let's crack on. So I've opened up my spreadsheet. The first thing we do is, as always, we take off the grid lines, go page layout, take off the grid lines, and then we go view and we freeze the first column and click on the A column, insert another column, and make the A quite small and the B quite large. There we go. And the first thing we do, so we go, let's put it up here, HD, go data, and go stocks. Always keep always write the company name in A1 so that we can keep reference to it when we need to pull things like the market cap and the ticker, the current price, etc. All of these things. So ticker, the date today is, can everybody see? Let me just maybe zoom in a bit more. Yeah, that looks better. We want ticker date, current price. We'll just go current so it doesn't go on the next. We go implied. Then up, down, the upside or the downside. Obviously this is stuff we're going to come back to at the very end, but for now we can go equals A1, and we want ticker. HD, today's date is the 20th of September 2025. The current price equals A1 dot, oh sorry, you go, where's it gone? There we go. Price, yeah. And we can leave these two, let's do a bit of formatting. We want a bit of fill. There we go. Border, do the like that. And the same with this one. Border. And there we go. Now we can start building out the assumptions. We're only going to do the last 3 years of, maybe 4 years, because we'll sort of forecast the rest of 2025, but we'll be projecting from 2026 onwards. And what we'll do is later in the year, when full year, when full year results are released, we'll come and update it properly. So segment switches to do bear base bull. And as you can see here, there are 4 revenue segments. So building materials, decor, hard lines, and other net sales. You can actually, on the full year statement, they break it down by, or each sort of part of the house that you can buy things for Home Depot from. Sorry. So yeah, you can. If we were doing this properly, we would absolutely go into this more detailed approach. But because we only have these for the full year, we don't have it for 2025. Therefore, I'm just going to keep it as this. But when the full year results come out, I'd highly recommend going in and breaking it down into those more detailed segments. Building materials, decor, or we're going to go hard lines, other net sales. And if this is your first time, all of this will come clear as we start building why we need these. These are what we're going to use to do different simulations based on, well, bear, base, and bull case scenarios. TGB. There we go. Okay, now we can start building. Assumption, so this is now a revenue segment, revenue build we'll call it. The way we do this one, the first is going to equal B10. We have the next line, percentage growth, bear, base, sorry. And we might want to look at what percentage that is of revenue. We can just keep copying these 4 times. We need to change what the, so if this one is B10, this equals B11, B12, B13. And then here we want, so the year we're going to start for the revenue is 2022. So we go 2022, and we then go 2022 plus 1. We don't need these. What is that? 26, 27, 28, 29, 30. We don't need the last 2. I'll zoom in a bit more. There we go. So let's start filling these in now. So in 2022, revenue was 54,572, 54,572. And then let's do, we want this to be number, we want this, no decimal places, and then number, no decimal places like this. Yeah, that's fine. And you just want to copy this format all the way along. 52661, 52756. Then the percentage. So now the percentage growth, you go in the 2023 box, go equals the 2023 figure divided by the 2022 minus 1, and that gives you the percentage growth, or in this case decline, and we'll do that all the way up to here. Now let's just format all of this so it's ready. Decor, okay, 554, 442, 51945, 790. And we can just copy here and paste. Now hard lines. 48389. Oh, sorry. It's good to have consistent formatting because it looks cleaner and it's just nicer. 48562. And then the other net sales, this seems to be something only for 2024. Is there a reason for this? So this is these other net sales are from an acquisition, which will probably, I mean, eventually it will all get incorporated into this, but for now, yeah, okay. All we need to see is $6,406. Okay, let's move on to 2025. Okay, here we are down here. So for the 6 months ended, they did 27 billion in revenue. In the previous year, they did 26,584. So, I mean, it's just under doubling the revenues. 50, yeah, 53. Yeah, so it's just under. So if we do, well, let's be accurate. Let's not. 26,584. Why did that not work? Equals divided by 26,584. Okay, there we go. So we do here 27,103 multiplied by 1.9845. Okay, there we have it. We do the same for this one. Is 26, so they're marginally doing better in the first half of the year from what we can tell so far. Let's see if that does ring true for the rest. Hard lines. It's 1.901 equals 2606. And then these stores were here. Okay, so 5689. Well, it did 6.4. I mean, this is quite hard to guess, but it's such a small part of their total revenue. We'll just put it as if it's 5689 here in 6 months. Let's just put it as a. Let's call it 9,000. But we have to be careful because this is obviously not go. No, let's just go 6,500. Let's not distort it too much. So we want now to start projecting out the revenues for the next 5 years. So we'll take the average of the last 3. Where's it? Oh, there we go. And we'll put and make sure when we put this one in, it needs to be done up here. So our base case growth rate, let's call it let's call it 1%, that it trends towards 1%. We might need a couple more. There we go. And that's going to be equal to G10. None of this should be, I don't know why it is. There we go, it's not bold anymore. And okay, now the next bit, if you've, okay, so we go to forecast these three here, we take this year, the first year forecasted, and we sort of just like spread it out over the thing. So you take the 2026 year minus the 2026 year minus the final year in 2030, close brackets. You then divide by the final year minus the first year. And you close that. And what we want to do is we want to lock the K in. This can be, no, we want to always lock we want to lock this one in completely, even for the other ones, but we want the row to remain the same. And then we have, that's okay. Let's reformat this. 2 decimal places is enough. The column width is always 10. So yeah. Oh, sorry, let me just pull this up a bit so you can see it better. Okay, that's done now. We're going to say that a bear case, it does 95% of this growth rate. So it will be, what do you call it? We do that for all of them. And we put the bull as 105%. So, I mean, if it's a 1% growth rate, we'll say it's going to be 0.95% on the bear case and 105% on the bull case. I mean, Home Depot is a very mature company. It's probably not going to differ too much from that, really. So now what we do is we take, what number is it? E10. So you go G27 multiplied by E9 and lock in E9 because we're going to take it all the way across. This doesn't look good. It's going to equal multiplied by oh, that's not really a bear case because it would actually be a better growth rate. So in this case, what we have to do is, well, actually, let's give it a bit more. No, keep it like this. Well, it's all going negative and it will all be trending upwards. Is this going to be okay? 1 second, let's just, yeah, I think what we do is let's try, see what it would look like in, yeah, let's do it like this. Just for this one, we're going to put it as 105%. Because we're saying it's going to decrease further if it's a bear market, and we'll do this one by it's equal no, sorry. So yeah, okay. Okay, but now we'll start properly on this one. We do the cell minus multiplied by E10, and we lock the E10 in. Just format it so it's there, and then we go like that, and we do this one multiplied by I10 and lock the I10 in like that. And there we're good. Now we go put all of these, put 2 down here. Because 2 is the base. So that's what we're going to initially build on, then we can flick it around. So you go equal offset, the cell that you're in, G25, then comma, C10, lock the C10 in, then go comma 0. So can you all see that? What's going on here? Offset, the cell we're in, so the brackets, the cell we're in, G25, comma, C10 for this switch, comma, 0, close brackets, and then we can go like that. And there we have it. It is, let's percentage, a couple of decimal places, and we just pull this all the way along. And now, to work out what the revenue is going to be, you go the previous year multiplied by 1 plus whatever the growth rate was. In this case, it's negative, so it's going to be less. And then you just copy it across like that, easy. Now we're going to, hopefully this should all come in quite nicely. Okay, yeah, that's good. Oh, perfect, amazing. Now we'll just do that the same with this one, but we need to change this to C11. Put it across, and we could pull. There we go, like magic. Let's do the same again for the no, it's not like magic. Now it's okay. Let's that is because we haven't put a in yet. So we would call what do we think is going to go? You know, maybe let's go 0.5% equals G11. Yeah, we can. Again, because this is okay, most of this is going to be negative. So let's switch this around for this one. So the bear is 105%, and the 95, but just because we're dealing with negative numbers, we'll do it like that. Sorry, we're on this one at the moment. I forgot to do. So this can, let's just change it to E, but lock this in now. And until it gets to, then this one can be I, just so that we have a, it's just so that it's, because it's a positive number, it needs to, no, it's okay, 34 times. Okay, that's better. No, sorry, again, I did it wrong. It needs to be I, but 11. There we go. And this needs to be E, 11. But why is this negative? this should not be negative, equals multiplied by, yeah, that's better, label 11. This need to be I, sorry. Perfect. And then for this one, look, this is positive, so let's go with a 2% for hard lines. What is it? G12. Okay, looks good. But it needs to be multiplied by E12. E12. But these can all be and this is there we go. Then for this one, let's not because we don't really know what's going to happen with it. I think it will just eventually get incorporated into these products segments. So let's just do a 1% growth rate per year on this one. So it equals 6,500, 1 plus. Just bring that across. Okay, that looks good. We'll delete these rows. Perfect. Okay, let's put a line in here to get the total revenue. Need a border just on the top. Here we go. Total revenue. Bold it. Percentage growth. Italicize. No. Okay. So equals sum. Put this one in, otherwise it will we need to put these ones in, otherwise when we just copy it down here, it won't pick them up. So that's why we do it. Oh, sorry guys, I'm doing that too close to the bottom. But yeah, there we go. So let's just have a quick look at this, how it looks. Yeah, so that's the revenue build. And now we're going to go on to the income statement. So we take this, we come here, and we go call this income statement. And the first is revenue. We just put this equals. I'll zoom in so it's easier to see. We just copy it all across. Sorry, let me zoom in for you guys. There we go. And then we're going to, okay, that's done. And then again, we just Copy the growth. Then the next thing is EBIT, and that is the operating income percentage. Then and for that we need the income statement, which is here. We're going to do it first on the previous years. Where is it? Come on, there we go. So operating income here, that's what we'll use as EBIT. I mean, if there's anything here that is not really operations, don't include that. We just want this bit here. 24. What is that? 24039. Two one 21689 21526. No, don't cross it out, just copy the formatting. Take the EBIT divided by the percentage of revenue. This gives us our percentage, and we just pull that along. Now for 2025, let's see what it was doing. So total operating income, okay. So it's 11,688. So it's fairly similar to last year. And last year came to 21526. So let's see what that. So 1.85. So let's take the current year. Well, the first 2 quarters, first half of the year, 11,688 multiplied by 1.8536. Yeah, so the EBIT margin is in the teens. Let's project it out. Now you don't just copy this over, you go equals, you take the revenue and you multiply it by the EBIT margin. No. So yeah, we copy that over and we come, and there we go, there we have it. Now we take taxes. So for last year, provision for income taxes, that's what we want. So for the 22, 23, 24, 5372. 5372. 4781. 4781, 4600. We want to see what that is. Well, to work out what the tax rate is, we want to see what that is as a percentage of the EBIT. So equals, take the tax rate, well, the tax is paid, and divide it by the EBIT. So that's a 22% tax rate, and we can do that up to there. And now for 2025, 2563. So it's pretty much the same as last year. Let's do it anyway to be precise. 1.814 equals 2563. 1.81459. Oh, we didn't need to go all that way, but there we go. That can't be right. No, because I've got it wrong. I think it was 1.81. No, so it's 2563. Sorry, guys. There we go. See, that looks better. Now we take the average again from the last 3 years, and we get up here to 22% tax rate, and we go the EBIT multiplied by the tax rate to get what the provision for income taxes is going to be. So that's the initial part of that. We're going to come back to this later when we're actually doing the DCF, because we want to have a way to simulate what different EBIT margins, the impact of what different EBIT margins will have on free cash flow, but we can't do that just yet. The next item we're going to go on is, so we've done the income statement. We now need the cash flow items. And these are the depreciation and amortization, one second, let's just put these in place. The CapEx, and the change in net working capital. Change in net working capital, but for now I'm just going to call it change in NWC so that it fits. And okay, let's start building that out. Looks good. To get that, so to get these figures, well, let's start with the annual figures first. To get them, we have to go to the cash flow statement, which is here, and we want this one, and then we want for CapEx, capital expenditures, and change in net working capital is these items here. Yeah, that's what we want. So let's start with, okay, depreciation, 2796 in 2022. There we go, 2793,061, 3336. And as a percentage of revenue, we go divided by there. Okay, that's enough space on the screen. I can have both of these up. Now CapEx 33119. That's what it starts with. So they are spending more than they are depreciating. 3226. 3485 as a percentage of revenue. Nope. Okay, now this change in net working capital it's a bit because there's just so many different ones that we need to make sure that we get it right. Okay, let's start. So we go equals 2796 plus 179 plus 366 plus 111 minus 2830. In brackets it's negative. Ideally we want a negative net working capital because that increases the free cash flow, because you go minus net working capital, change in net working capital, and so it turns it into a positive number. And it usually means they have favorable terms with their suppliers, that they've got a number of days to pay for goods, etc. And that can be very positive for free cash flow. Plus 4137 minus 184 minus 1411 minus 318. Have I got that right? Yeah, because there's this big bit on yeah, that's okay. $743 plus percentage of revenue. So last year, we'll just do this and multiply it by 2. We don't have to be overly accurate on, I mean, you do, but it's not going to affect the outcome that much because it's, say, such a small part of revenue. But for speed, we'll do it like this, and then when we have the annual reports, we can be more accurate. So let's multiply it by 2, don't I? So just put it in brackets, and then at the end, multiply by 2. Okay, that gives us I haven't done the depreciation yet for these guys, for DNA and the capital expenditures. So if last year was divided by 1615, 2.06. Okay, so we'll do it at slightly higher, 1720 multiplied by 2.0656. And the same with capex. If we take last year divided by 1566, 2.22, so 1723 by 2.2254. Okay, yeah, we're good now, we're good. So take the revenue, you multiply it by what we think it's going to be of revenue, and we just slide all of these along. We do the same here. There we go. Looks good. Looks good. Yeah, and also it's good to sometimes know what the percentage of depreciation and amortization is relative to capex. So yeah, that's what they're roughly. I mean, roughly in line. Now the next thing. So now we're actually going to start building out the DCF. And I know this feels like it's repeating itself a lot, but it does make sense once you see what happens at the end. So yeah, okay, let's start doing the DCF now. We start with the revenue. So revenue, we can just go equals. We just zoom out a bit. Doesn't really matter. Again, it's always good to have things like the percentage growth, so that if you want to glance at it, it's easy. You don't have to keep scrolling all the way back up. From a user experience, UX perspective, it is a lot better, even if it can be a bit arduous to keep typing over and over again. Now we are going to bare base create the switches for the EBIT. So we copy the EBIT up to 2025. We get it there. And then we do the usual, get it as a percentage of revenue. We've got that margin there. We come up here, and then we want our boxes. Put them here, come to 2030, and then we have to put in a, the margin is trending downwards. Let's go with 14. %. I can't remember what the thing was. G. There we go. Cool. But these haven't worked, have they? No. Okay, that's fine. G84, K84. And that should actually always be locked in. There we go. Let me just check I've done that on the other ones, because I knew I did something wrong. You always have to proof your work here. And what I'm doing here is I'm just locking in this cell so that it stays that way. So when you just copy and swipe it over, it will always stick with that one, rather than yeah, like as we saw without it, it went onto the L, which is not what we want. And look at the revenue. So in the last 4 years, the revenue has grown from 157 to 161, and we're saying it's going to grow at a similar or slightly less rate. So it'll go from 161 to say 166. 161.8 to 166. It's not a fast growth company. Maybe, I don't know, maybe it goes higher, but well, it doesn't really matter now what we're building at. Once we have more information, we can add, we can adjust. But for now, let's leave it as it is. So, okay, we all know what to do here. Well, this needs to change. It needs to be E15. We just pull it over. I15. No. Then we go offset the cell we're in, G82, and it will be about C15, won't it? It will be C15. Lock it in. Now we take the revenue multiplied by the EBIT margin, and we have it. And what we'll see is when we play with the switches, so okay, I'll show you now. It's going to change. So let's say, okay, remember this figure 2287. let's put it to the bull case. So we go 3, and you can see it's changed. And so that's what we want to do. You can isolate it down to different parts that you think are going to do better than others, and that way you can simulate what your what free cash flow you think will be forecast, and ultimately what the implied share price is. Now we go for the taxes, and that is equals, just again take this line, but we just do it up to 2025, and you'll see why in a second. Because the reason we want to do that is we want the taxes paid to change relative to the EBIT margin going up or down. So we want to have it dynamic. But we'll keep the same technique of taking the average state tax rate from the last few years and forecasting that out, and then we'll go equals EBIT multiplied by the tax rate. What's wrong with you? Number. I don't know why this is not. Yeah, it's a percentage, so let's go. There we go. And this next line is now the EBR, so the earnings before interest, but after tax. So EBR, and you go EBIT, and take away, subtract the tax. You just copy that all the way along, and there we have it. The first part is sort of done. Now let's go and add in, so now to forecast the free cash flow, we've got the EBR, and now we need to do what we do with the cash flow items. And that is very simple. Again, just copy them down from where we have them up here. All the way along. The CapEx. Copy that across. There we have it. Now, we take the border, we put a border in, and we have unlevered free cash flow. We only need this for 2026 onwards. So, okay, let's bold this one so we know where it starts. So here so unlevered free cash flow. We take the EBR, we add back in depreciation and amortization because it's a non-cash expense. We then subtract the CapEx, and we then subtract the change in net working capital. And that gives us, well, 13 and a bit billion in free, or 13.8 billion in free cash flow. And we can forecast that out for the next 5 years. So that's what it is in nominal terms. We now need to work out what the present value of that free cash flow is. And we do that, we need to build the WACC. So let's do that. Again, so we have to just do a bit of this. Grid lines off. Zoom in a bit. HD. We need the data because we need the market cap of Home Depot. And so the WACC, that's what we'll do, and that it will consist. So the WACC is, okay, let's write it out, equals the percentage of equity multiplied by the cost of, actually, sorry, 1 second, let me just, sorry. So the WACC equals the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. So the way we're going to do this, so we need market cap, we need the cost, sorry, no, we need the percentage of equity, cost of equity. I'm not going to build because this is a predominantly US company, I'm not going to build out the cost of equity in stages, we'll just rush through it here. But if we had international revenues, which I don't think Home Depot does, so we would obviously go and do that. We'll do the obviously we take the unlevered beta and then relever it, but otherwise we're not going to build out the equity risk premium because the majority of the revenues come from what do you call it? The US tax rate. Then we go total. So the market cap, we can actually go equals A1 dot market cap. We need to divide it by 1 million. 1, 2, 3 to give us the because this is a $413 billion company, so it's done as 413,772 million, but obviously it's billion. The risk-free rate, we'll use the US 10-year Treasury, 4.133. The equity risk premium is going to be, I didn't actually realize, I thought he just did this twice a year, Demoden. He did it in the start of the year and the middle of the year, but it looks like he does them throughout the year. So, okay, let's use this one, 3.68, as the US risk premium, country risk premium, sorry. And then the beta, we'll do that, but let's do I need to add a column because we need to know what the debt is. And the debt for the company currently is, we need to go to the balance sheet, and that's up here. So it doesn't have any short-term debt. Long-term debt is about 46 billion, 45917. It's 45917. Which means the total down here is, take this plus the market cap plus the debt. And the percentage of debt is the debt divided by the total. But this is a percentage. So that's a bit more. Perfect. Okay. And the cost of debt is, let's look at what the interest payments are. So for the full year, the interest expense was 2321. Remember that number, 2321. So it's a bit more. So if we do 1190 multiplied by, let's say 2.2, sorry, 1 second. And that will be the interest expense for this year. Do this divided by, so it's about 5.7% the cost of debt. And then the tax rate, if they tell us what the effective tax rate is, we can just use that. But if not, we'll just use what we calculated. Okay, 24.2%. Okay, now the beta is going to be, well, let's pull up Demoderan's beta thing. Building supply, so this one. That's what we need, the unlevered beta. Building supply, I'm going to put it as. That's at 1.57, is that right? No. It's 1.55. And to calculate the levered beta, what we do is the unlevered beta equals the levered beta divided by 1 plus 1 minus the tax rate multiplied by the debt divided by the equity. So to rearrange that, levered beta equals unlevered beta multiplied by 1 plus 1 minus the tax rate multiplied by debt divided by equity. Okay, so now we've got that. Let's calculate what that's going to be. So we're going to take, so it's going to equal, what the unlevered beta is 1.55. Okay, let's leave that there. Then we can go, don't need that now. We go lev beta. We'll leave that there so that we just say that we can keep it. So if we update it, it won't, we can keep it dynamic. 1 minus the tax rate multiplied by the debt divided by the equity. Okay, so 1.68 equals, there we go. Now the cost of equity is the risk-free rate plus the beta multiplied by the equity risk premium. Let's just, yeah, so we have that now. Now we can work out the WACC. And that is, so the percentage of equity multiplied by the cost of equity. Let's put it in brackets just to be safe. percentage of debt times the cost of debt times 1 minus the tax rate. There we go. Perfect, 9.72. So that's the WACC we're going to be using. So we come back onto our other spreadsheet, and we can fill out these up here. So we put the WACC as 9.72%, and the bear case is plus 0.5%. Stop it. Then let's just copy this over and we'll change the sign. No, didn't work. There we go. Because the lower the WACC, the less risk, so the more bullish it is. Obviously, and the other way around is the higher the WACC, the more bearish it is. So the terminal growth rate we'll put as 2.5%. And this is what's generally used for mature companies. And for the bear case, we'll minus 0.5%. And for the bull case, we will add 0.5% because a higher growth rate is bullish. There we go. And here you go WACC. So choose. And you just, no, I've done that wrong. Equals choose. You've gone to the WACC, and it's just these 4 in a row that we need to put in, and then that will act as a switch. And we do the same for the terminal growth value. Now, okay, let's get to, now this is the fun part because we're going to start calculating everything. All that, let's just call it present value of free cash flow. So we'll go PV of UFCF. And that is going to be, let's put some, just here. Actually, no, I normally do it here. Add another line and go 1 on 2026 and just plus 1 until you get to 5 because we're doing this 5 years out. So PV of UFCF, that is going to be, we take the free cash flow and we divide it by 1 plus the WACC, which we lock in, and then we go to the power of the year. And in that case, it's the 1, and we get it like this. And then you just do the usual, and you copy it over. Now we want to look at what the terminal value of the company is. Let's maybe distinguish them a bit more. So the terminal value is going to equal the final year multiplied by 1 plus the WACC divided by the WACC minus the terminal growth value. And that's what we get as the terminal value, 242 billion. And the present value of this, so PV of terminal value is going to be divided by 1 plus the WACC to the power of that final year, number 5. There we go. Now we want to find the enterprise value. And that is done by, there we go, sum. You take the present value of the terminal value and the present value of the free cash flows forecasted, and we get that as being 21079, And then we're going to work out the equity value next. And so we add the cash minus the debt. So the cash we haven't looked at on the balance sheet, that is, sorry, wrong page. Where's the balance sheet gone? Here it is. So cash and cash equivalents, 2804. And the debt we know from the WACC is, what was it, nearly 46 billion. Almost there, almost there. The equity value equals, take the enterprise value, add the cash, and subtract the debt. Now we want to have the diluted shares outstanding and the implied share price. Almost there. This is the best bit. So the diluted weighted average common share, so it's not basic, we want this one, this figure 994, but it's not really that much different from its basic, which is good. 994. Now it's the moment of truth, where you take the equity value and you divide it by the diluted shares outstanding, and that's what we get, a share price of 168. So what's that? K113 equals K113. And just like, I mean, if you saw the Costco one the other day, you'll see, yeah, it looks like, it appears that it's significantly overvalued. I mean, let's see what happens if we go completely bullish. 206. I mean, it's still very, very, overvalued for what it is. I'm not really sure why. I guess one of the things, you're paying a premium for a well-run company. It's got quite a lot of market share. It sort of operates in a duopoly with Lowe's. So yeah, I guess that's probably where the premium for it is coming from. So yeah, there we have it. The DCF for Home Depot. Yeah, we'll be back soon, and we'll do another one. I mean, let me know in the comments if you've got any companies that you'd like us to do. I think just keep them, I guess, mainly US listed, and I guess sort of fairly mature in at least their revenues. Let's not do anything high growth, because the DCF doesn't really work for that. But yeah, okay, we'll see you in the next one. Thank you.